Have you ever just stared at your trading screen, watching the market chop you to pieces, and it just feels like it's speaking a language you totally don't understand? Yeah, you're not alone. But what if I told you there's a hidden language, a code that the big institutional players use to see the market's next move way before it happens? Well, today, we're going to unlock that code.
So, here's our roadmap for today. First, we'll decode that hidden language. We're going to look at how to read the market's real intent, and then how to predict its forced actions. After that, we'll check out a dashboard that makes this all super simple, and then, the best part, I'll walk you through 3 core setups you can actually use. This is all about giving you a real tactical advantage.
Okay, let's dive right in. The core problem for most traders, the reason so many fail, it isn't a lack of information. It's actually from looking at the wrong information. It's kind of like trying to read a book, but you're just on the completely wrong page. And that leads to this feeling, right? Why does the market feel so random sometimes? You see what looks like a perfect setup, you put on the trade, and then bam, the market just reverses out of nowhere and shakes you out for a loss. It feels like you're just guessing. But what if I told you it isn't a guess at all?
This right here, this is the light bulb moment. It reveals the fundamental difference. See, most of us, the retail traders, we're obsessed with price. We're constantly asking, where is it going next? But the institutions, the players who actually move the market, they're asking a totally different question. They're asking, how are we hedged against risk? And if you can understand their world, that's the real edge.
So how do we start to read their minds? Well, the first piece of this puzzle is something called spot vol beta. I want you to think of this as the market's poker tell. It's what reveals the true intentions behind all the price moves you see on the chart.
So, in really simple terms, we all know that when the market, the S&P 500, drops, fear, which is the VIX, usually spikes, right? Well, spot vol beta just measures the elasticity of that relationship. Is fear overreacting to the drop? Is it underreacting? Or is it reacting just like we'd expect? That's the key question it answers.
Let's stick with that poker analogy for a second because it's perfect. Think of a big price move as a bluff. A player shoves all their chips in the middle. While spot vol beta is our way of seeing what's happening under the table. Are their hands shaking with fear, or are they cool as a cucumber? It shows us the market's real conviction behind that big move.
And this is how it all comes together into 2 key signals. On the left, you've got a super bullish setup. Bad news hits, the market takes a dip, but the VIX, it barely even flinches. What does that tell you? It tells you the big money isn't panicked, they think the selling is hollow. Now on the right, the bearish warning sign. The market looks totally fine, maybe it's even going up, but the VIX is slowly creeping higher. That means institutions are quietly buying protection. They're getting ready for a potential rug pull.
Okay, so if beta shows us intent, our next tool shows us forced action. This is called gamma exposure, or GEX for short. And this is where it gets really interesting, because it reveals what the biggest players are mechanically forced to do, whether they want to or not. This is where market moves can become truly predictable.
So GX basically just tracks the positions of options market makers. Now these are the giants of the market, who have to take the other side of pretty much everyone's options trades. And to manage their own massive risk, they have to constantly hedge their books. It's that hedging action that actually dictates the flow and feel of the entire market. I absolutely love this analogy. Just picture market makers as a massive cruise ship. When we're in a positive gamma environment, they act like the ship's stabilizers. They're actively smoothing out the waves and keeping everything calm and steady. But when we flip into a negative gamma world, they basically become an accelerator. They're pouring gasoline on the fire and magnifying every single wave in the market.
And here's exactly how that plays out. In positive gamma, they are forced to buy weakness and sell strength. This creates that choppy, range-bound market that's perfect for fading the extremes. But in negative gamma, the whole game flips. Now they're forced to sell into weakness and buy into strength. And that is what creates those powerful, explosive trends that you do not want to try and fight.
Okay, so we have beta for intent, and we have gamma for forced action. That's a lot of theory. How do we put this all together in real time without having like a dozen screens and a PhD in math? Well, this is where it gets practical. We use a dashboard that acts like our personal decoder ring. And here it is. This is the ES Scalp Intelligence Dashboard. It takes all of that complex theory about institutional hedging and all that stuff we just talked about, and it translates it into a simple visual interface. The market regime, the beta sentiment, the key levels to scalp, it's all just laid out right there for you.
So what's so powerful about this particular tool? Well, three things really stand out. First, it's no man's land logic. This is huge because it tells you when the best trade is actually no trade at all. Second, it automatically detects the ceiling, which is a key resistance level where you'll often see rallies die. And third, it translates that confusing spot vol beta decimal into a simple sentiment score, so you can instantly feel the market's true mood.
All right, let's put this into practice. We've got the theory down, we've got the tool. Now let's build a simple, repeatable playbook. We're going to cover 3 core setups you can start looking for literally today.
This is your routine, every single time. Step 1. Check the regime. Are we in that choppy positive gamma zone or the trending negative gamma zone? Step 2. Check the beta. Are the big institutions panicking or are they calm? And step 3. Identify your target. Where is the nearest major support or resistance wall to aim for?
All right, setup number 1 is the gamma squeeze. This is your aggressive trend-following trade. The dashboard shows you're a negative gamma, and the beta sentiment shows that fear is expanding. So when you see a technical break on your chart, you jump on board and you ride that momentum. Why? Because the market makers are being forced to chase the price in your direction.
Now, setup 2 is the complete opposite, the wall bounce. This is your high probability fade trade. The dashboard shows a stable, positive gamma regime, and the beta sentiment is calm. When the price comes down and hits one of those key wall levels that are shown right on the dashboard, you look to trade a reversal because you know the market makers are going to be actively defending that level. And finally, setup number 3, the zero gamma pivot. This level is the dividing line between the chop zone and the trend zone, and it acts like a powerful magnet. If the price just drifts to it and then rejects, you've got a really solid scalp trade. But, and this is important, if it slices right through that level with volume and expanding volatility, the entire character of the market just shifted, and you need to immediately flip to a trend-following bias.
So, what's the ultimate takeaway here? Why is this approach so different? Well, it's all about shifting your entire perspective, from guessing about what might happen next to knowing the forces at play. It's about trading with real conviction.
This quote just says it all, doesn't it? You're not just trading some pattern on a chart anymore. You are literally aligning your trade with the forced mechanical hedging flows of the largest players in the market. You know they are pushing the market with you. And that, my friends, is a tactical advantage you just can't get from any traditional indicator.
So, by understanding this interplay between intent from beta and the forced action from gamma, you can stop just reacting to the market and you can start anticipating it. You're not guessing anymore. You're aligning with the powerful flows that actually move the price. So the only real question left is, are you ready to start trading with that edge?